Hello everyone, this is Harish Thakkar. I have over 25 years of experience in financial markets, primary and secondary markets. Let's get started. So primary markets are nothing but the new issue market. It's the first time around that a company raises capital and issues shares to the investors. Let's take an example. If there is a company that has been privately held, let's say for example a Zomato or a Swiggy, and both have relevance because Swiggy is yet to come up with an IPO and it's planning to come with one. So if we talk about this company, it is now being held by its founding members and other investors. What it is planning to do is sell these shares to the common public. So the first time that a company issues shares to the public, and when I say public, it not just means retail, but also institutions, mutual funds, insurance companies, and other institutional investors. So the first time a company issues shares to the public investors, it will be called as a primary market. In the primary market, securities are directly offered to investors, and the proceeds from the sale of these securities go to the issuing entity. The functions of the primary market is essentially raising capital. The idea is to raise capital for expansion, for new organic or inorganic growth. The purpose could be anything. By issuing these new securities, these entities finance their operations, investments, and growth initiatives. The very popular way of primary market issuances are either offer for sale or IPOs, and we are going to be talking about these in far more detail as we go along. Now let's talk about the secondary markets. We've already established that the primary market is the first issuance of the security. What happens after that? Once the security that is issued to the investors, be it offer for sale or IPO, it gets listed on the stock exchanges. All the trading that takes place on the stock exchanges, all the buying and selling is nothing but secondary market. So if I were to summarize this, the primary market is the first buying and selling. All subsequent buying and selling is secondary market. The first buying and selling is between the company and the first investor. All the subsequent buying and selling between the investors or institutions is nothing but secondary market. So the secondary market involves the trading of existing securities between the investors. Let's talk about why do we need a secondary market, or what are really the functions of a secondary market. The very basic fact that an investor is investing into equities is the fact that there will be capital appreciation, which means the price of the security has the potential to go up, will increase. How can a price increase unless and until it's traded? There has to be a market for price to be discovered. Hence, liquidity and price discovery are the two main functions of the secondary market. Liquidity allows investors to exit and enter the security with ease. It allows them to buy and sell the security because there are many other investors who are willing to buy and sell. Given the fact that there are many investors, many buyers and sellers, I won't use the word fair value, but a value which is acceptable by most people will be discovered based on the demand and supply. Hence, the secondary market allows price discovery and is able to give a right value to the security. The third one is transparency. Companies that are not listed are not really bound to give away information, financial information relating to their performance or operations. When a company is listed and is traded on the secondary market, the companies have to make this information public, which means the secondary markets also provide transparency in the entire process.
Found this session valuable? Hit the like button, subscribe to our channel, and tell us in the comments below what topic we should dive into next.